Hey guys, it's Dave Hathaway. We're bringing you another educational episode today. I brought on a specialist that is a lender. His name is Jordan Weimersheimer. We're going to just share our experience as specialists, as an investor, and as a lender, and how you can utilize lending as an investor and what to look for. So I'm going to pass the mic right back over to Jordan to introduce himself.
David, thank you so much for inviting me. I was actually honored. I really was, because I've seen your videos come out on a regular basis and I love them. I've worked with you now. And honestly, I don't even know how you and I got connected, but it's been a few years. I would say about 4 or so years. And I've seen you grow your business exponentially, which is also great. You know, one of the beautiful things about my job is I look at it as an opportunity to help others grow their business. Been a mortgage lender for 20 years now. Most of my business for the first 15 years was people who are buying primary residences, maybe second homes, an investment property here or there. I've worked for mortgage broker shops and then banks recently, the last several years, for about the last 10 years. I still do work for a bank, Presidential Bank. We are based out of Maryland, but I transitioned about 7 years or so now from working with just strictly homeowners, residential homeowners, retail homeowners, to investors. And I've always looked at it, like I said, as an opportunity to help them grow their business. And being able to help new investors, especially, I've worked with a ton of new investors, to help them look at their deals. I myself have done some investing, very limited, but I've seen enough and been around enough investors and working with them for the last several years to know typically what is a good deal and what's not. If you want to get into it, Dave, I know you had some questions you wanted to ask me. Yeah.
I appreciate you. I appreciate the introduction. I wouldn't have you on if I didn't think you were a player and a rock star as a lender. You've been instrumental in helping us with building our investment portfolio, and you know much more about lending than I do. So it's easier to throw questions at you and than to field them myself. So thank you for being on. We will get right into it. If you guys stick around at the end, Jordan's actually going to quote out property for me so you can see the different lingo that we talk about, and we do it just like a normal phone call. I mean, you get to see us live, which is a little bit different. I'm not normally FaceTiming him when I need a quote on a property. It's normally just a pick up a phone call and say, this is what I got. And he, 5 minutes later, bang, bang, bang. Okay, let's roll with it. If you stick around at the end, we'll do that for you guys. I'm going to start off with the first question being, why is lending important for real estate investors, and how should they think about lending?
One of the biggest hurdles mentally, I feel, for an investor is looking at financing as this roadblock instead of you looking at it as a tool, as an avenue to be able to be a successful investor. Just like a cost of materials, just like the cost of labor, just like the cost of selling the property at the end, right? Or paying a property manager, it's a cost of doing business. Right now, is it higher than it was maybe 2.5 years ago, 2 years ago? Sure. But the cost of materials, the cost of everything has increased, and it all kind of, correlates to each other. But it's a means to an end. And unless you are entering this business with infinite pockets, and even sometimes then, I know a lot of investors that I have that have way more money than I have and more than most, and they still use financing because it's a tool. And why put your own money at risk? Why not leverage it and use that? And it's all a matter of course, if the numbers for the deal work. If it's too tight and you're in a position where you have your own capital to do so, by all means. The other thing is that if you really want to scale, if you're not leveraging, how are you going to do that? Even if you do have your own money, if you have enough to do maybe 1-2 deals, how are you going to work on 4 or 5 at a time once you get to that level, once you have that experience, without using other people's money?
To kind of just summarize that up, and you can correct me if I'm wrong, it's an important tool just because investors are going to run out of money eventually. We don't have infinite pockets, and leverage is a tool that can actually juice returns. It can make your returns much better when you use leverage than when you just utilize like a cash on cash return metric, which I've noticed where I'm like, oh, if I leverage this, my return goes up to 12% instead of 8%, which a lot of people are like, oh, if I'm leveraging, my return should go down. And that all usually depends on the interest rate. But you can juice your returns and make them better. Is that correct?
Yeah, certainly. And I mean, it's a lot of about where's that cash being deployed. If you have let's say you have a rental 123 Main Street that's worth $200,000, but that all your $200,000 is sitting there, as opposed to leveraging it and putting it into 125 Main Street, right? And acquiring 2-3 more properties using that property. It's all about the numbers and where do they lie as far as the amount that, if you really want to build that portfolio up.
Direct lender versus mortgage broker. What are those two different things? Is one better than the other? Should newer investors be looking for a direct lender? Should be looking for a mortgage broker? What do you recommend? And for context, what are you in the scheme of things?
Yeah. So in the context of a traditional debt, conventional FHA, VA, well, I'm a direct lender. I work for, like I said, Presidential Bank, and we lend our own money. In the context of a more commercial style loan, the debt service loans, hard money loans, I'm a broker. My company, Jordan Lev Mortgage, it's just me, little one-man shop. But, I have my website, www.jordanlevmortgage.com, and you'll find Google reviews about me. I act as a broker purely. And the benefit to that is when you go to a direct lender for this type of loan, they have one set of underwriting guidelines that they have to stick to. Whereas a broker, just like with insurance, right? A broker can have 50 different underwriters to shop with. And that's the same with me, because especially these types of loans, especially when you're newer to investing, there's going to be many different variables. And the commercial world tends to be like the wild, wild west. Mm-hmm. There's a million brokers out there, and there are no rules. There really isn't. So guidelines can change like that, and it happens to me all the time. And these lenders, if you're working with just one lender, you limit yourself. You have this little box. Whereas a broker, you have this much box. And if it doesn't go here, I could take it there.
So are you saying you are both traditional and mortgage broker? That's what
Correct.
To summarize that. I actually didn't know that. That's awesome. So you're coming from the perspective of both being a traditional lender and mortgage broker, which is awesome. The next question is, when do you think investors should reach out to a lender? Is that just when they start looking? Is that after they found a property? What's your recommendation of the best time to reach out to a lender in the buying process?
Whether you're buying your first home that you're going to live in, whether you're buying your first rental, I always tell everybody a lender first, because you don't know what you're capable of buying at that point, right? Listen, with any lender, there's no obligation for anything. So a phone call, an email, have a conversation, whether it's someone like myself or someone who's very experienced, maybe in the financing mortgage world, something to know what you're really qualified for. What one investor might be qualified for doesn't mean the next is, right? Just like if you're going to buy a house, it's all going to matter. Now, on these types of loans, fortunately, the debt service loans, which we'll kind of get into more, income doesn't matter, right? So someone might think, I've had a lot of new investors where they're like, my tax return is this or that. And I'm like, don't worry about it. Because we were talking earlier, David, you don't know what you don't know. So it's always best to reach out, have the conversation. There's never an obligation, at least with me. I don't know what, other people do, but there's no obligation, and you at least find out where you stand. And when you're going to make an offer, unless you have, that money sitting in the bank, no one's going to, these days, especially right now, it's a seller market. So if you don't have some sort of proof of funds, pre-approval letter, you're not even getting into a property these days. Even if you're buying from a wholesaler, they still want to see some sort of proof of funds.
Gotcha. And just to summarize there, you're saying, hey, you should reach out to a lender as early as possible so they can know their buying power. And so they don't, find a property, they're like, oh, the numbers work great. And then they come over to you or another lender and they go, the lender goes, well, you can't afford this property. And then all of your effort and work was in vain.
100%.
And you got to go back to the drawing board. But now at least you know what your qualified and what your buying power is. So I guess the answer to that is as early as possible.
Yeah.
Whenever you're even thinking about buying a property. Hey, that will also help you as an investor to define your filter. So you're not looking at properties that, 750,000 if you only have $10,000 in the bank, and or you have to figure out something creatively.
Yeah, or rural. Let's say you're in an area where you could even be in Maryland, right, where you live, or Virginia. There might be certain parts where it might be a good market, but it might be something that is too rural, and rural financing is extremely difficult on the commercial side. On the residential side, the conventional side, easier. So it's those types of things. You got to know what lenders will allow, and how do you know that unless you ask?
Gotcha. All right, I want to kind of shift our focus, and I want to talk about each one of the different financing options that investors have, and just briefly kind of discuss what that financing option is and who it's kind of meant for. We briefly hit earlier that throughout your investing journey, you're going to utilize different financing options as tools as an investor, and it might shift. You might start out with one type of financing option, and then now that you have 10 properties, you shift to a different one. So kind of who these products are structured for on a basis. We'll start out with FHA, and we're going to go through a bunch of different financing things. What is FHA? Who is that for as a real estate investor? When would you use FHA financing?
Sure. So FHA and conventional, I will kind of tie those two in together.
Okay.
For one reason, we'll kind of branch off into conventional. So FHA is the Federal Housing Administration, administered by HUD, and that is purely for people who are buying their primary residences. So that is where you would apply a full doc loan. You have to be employed, have regular income. If you're self-employed, you have to be showing income, and you would qualify for a primary residence. The same with conventional financing. Now, these are going to be, I have a lot of new investors. This is how they start off, right? And I have a lot of investors who are, one of my better clients has, in the last 3 years, he has 17 rentals now. First house, it was his house he lived in. He bought it with regular conventional financing, probably 5% down. I wasn't a part of that because it was before I met him, but he started renting rooms out to kids in college. It's near a school. And ultimately he moved out of that house, right? Turned it into a straight rental property. His first asset in his rental portfolio, he got into with 5% down. Yeah. And ultimately, the value appreciated. He refinanced. He even took that money out, right? So his second house, again, he moved into it, purchased it with conventional financing. A year or so later, moved out, had his second rental property, again, 5% down. Okay. And that you can use FHA or conventional financing. And this is how a lot of investors get started. And when you're, especially if you're a little bit younger, it might be a little bit more difficult to go this route if you're, maybe 40 something and have a couple kids to have to move, every year. That maybe isn't realistic. But if you are getting started out, you're younger, you're hungry, you don't care, this is a great way, using either of those options. Now, conventional, you can also purchase and acquire rentals with putting as little as 20% down. But I kind of want to preface that, and it's going to kind of leak into where we want to go with this, David.
Yep.
And which is into the more commercial style debt service loans. Okay. Now, in a normal world, before inflation and rising interest rates, a conventional loan, which goes in your name personally, okay, a debt service loan is typically going to close in an entity, which when you're building a portfolio is the route you want to go for several different reasons. I'm not going to get into that. I'm sure you have another video or will.
let me stop you there just to pull out a nugget real quick. And I apologize for interrupting you.
No.
The FHA and conventional have to go into your personal name. And then just for the viewer's sake, you've talked about full doc loans or no doc loans. And I just want you to just expand on that a little bit so people kind of know what you're talking about there.
Sure. So any traditional financing, traditional meaning conventional, FHA, VA, let's not leave out the veterans, right?
Yep. Correct.
VA is great because as long as you have enough of your eligibility, you can buy a property and then you can go buy. It has to be a primary. People don't know is you can have more than one VA finance loans. I have a guy that has 3 before, but they have to have enough coverage. But that's getting into it. So any of those are possible, okay?
Yep.
But that means you have to show income, and you have to qualify on what's called your debt service, which is your money you have coming in versus the money you have going out on credit. And typically that percentage, that ratio is 50% or under is what an underwriter is going to look for. So we use gross income, not net. So if your gross income, right, let's say you make 60 a year at $5,000 a month, as long as your new mortgage payment, and maybe you have, a couple $100 student loan, as long as that total is under 50%, typically you'll be okay. Now, when you get into your self-employed, a lot of self-employed peoples become investors, right? Because they're more entrepreneurial, et cetera, whatever. Becomes a little bit more difficult because, right, you have write-offs, and while your company might be bringing in X amount, you're only paying taxes to Uncle Sam on Y, and it tends to be a little bit less. And that's where you really need a quality lender to be able to, that has experience to look at those returns and analyze them properly and make sure, yes, you are, approved for X amount, et cetera.
Gotcha. And just to summarize those FHA, VA, conventional, which we're lumping them in together, you're normally going to have, and correct me if I'm wrong, you're normally going to have the lowest interest payment. You're going to have to show full documentation. So your tax returns, come up with, you have to have a good debt. What did you call it? You call it debt ratio?
Yeah.
Debt to income ratio. And you talked about people purchasing a property in FHA as their primary, and then, having the intuition to kind of turn that into investment property down the road. There's nothing that withholds you from doing that. You can purchase an FHA and then you can move out of it and turn it into a rental property, and it can be a great investment property that has a very good lending product on it.
Complete disclaimer. Whenever you're buying a house with FHA, VA, and conventional signing that it is your primary residence, you have to live in it. You cannot purchase it with the intention of turning it into a rental property in 30 days. That's illegal. They can call the note on you, etc.
Gotcha. But you can live in it and rent out rooms is what you're talking about. Yeah. Moving on to the next lending product that investors should know about, and you started talking about them. DSCR loans. What is a DSCR loan? Who is it targeted for? How can a real estate investor best utilize it?
Sure. So that is the debt service coverage ratio loan. And this is when you get a few in, start to build your portfolio, this is the product you're going to use. And for a couple of reasons. One, there's limited documentation. Credit matters. Okay.
Gotcha.
Often there's a misconception that it's just the asset, just the property, but credit matters because it is based on you're going to repay it. And what better way to do that and judge that other than your credit score, right? So credit matters. There is a personal guarantee that's signed with these loans, but the title and the loan documents are in the name of the entity.
Entity being LLC, S Corp, C Corp.
Yes.
Trust, whatever entity you want, just not your. Sometimes I don't totally think everybody understands entity, but
business.
Gotcha.
So corporation, it's really typically going to be a corporation or an LLC.
Gotcha. Yep.
Yeah. Are what those are going to be held in. So most of the time they don't report to credit, which is great. There are a few I've seen that do, but very, very rarely. And most of the investors that I work with don't. The other benefits are there's no limit. So once you get conventional, so I'm kind of backtracking a little bit. Okay.
Yeah, that's a great point.
Financing, you can buy rental properties in, not FHA, not VA. Conventional financing was if you had good income, good credit, the way to go, right? In our previous life, a year and a half, 2 years ago, the rates were better by about 1% or so. Okay. Going conventional, Now, conventional, it does cap you at 10 properties financed total. You can own 30, but if only 10 financed.
Is that regulated by the government or by the institution?
Fannie
Why?
Mae, Freddie Mac, which
Okay.
are conventional. Conventional means
Okay. So it's products by the government. The government is basically backing the loan, and that's why they're saying you can only have 10 of these, and they are artificially, not artificially keeping the interest rate low to try to create churn. What would you say?
Well, right now, that's the thing, right? So right now, you pretty much can't even do 20% down on a conventional loan. The reason being is, okay, a little very lay. A mortgage, when you close a mortgage, when you have any kind of mortgage, right, it gets pooled into a group of mortgages, and that gets sold on the stock market, right, as bonds, for example. Okay. The desire in the market for these conventional investment property loans has narrowed greatly.
Gotcha. And then just going back briefly to hit it for people, the DSCR as a summary is going to be for people slightly further on in their investing journey. What do you want to say? The person that's purchasing their fourth or fifth or 10th property, they're going to start using DSCR usually because the interest rate is not that much higher than a conventional, and it's going to require a lot less red tape. I don't want to say no documentation because that's what people say, no doc loan you'll see or hear. Nothing is no doc. You can't, no one's going to give you $100,000 and you don't show them anything. That does not exist. It just means it's a less documentation than a conventional through the government where they're going to ask you for pay stubs and everything else. You correct me if I'm wrong.
Yeah, I mean, a no doc you can equate to no income.
No income. Okay.
There's no debt ratio.
Well, let's just call it no income then.
No income, no ratio.
No income loan. We just
yeah, because we're going to look at assets. They want to see, where the money's coming from. Or if it's a refinance, do you have some reserves, right? They usually want to see a few months of reserves. Yeah. Usually not a big deal. But like I said, credit score and then the properties. No ratio on your income. But we're going to look at the debt service of the property, which is the market rents versus the taxes, insurance, and then your principal and interest payment. And of course, if there's an HOA fee. Typically, we need to see 1.1%.
You're looking at cash flow because a lender is not going to lend money on a property that does not make money or does not cover their mortgage and everything that goes around with the mortgage.
Well, you would think that, but I do have investors that will actually look at a no ratio. So we don't even look at it. Typically those rates might be a little bit higher, might be less leverage, meaning loan to value, which is the amount you can borrow versus what the home is worth. So it might be, 5% less, like let's say the max on a regular refinance, a rate and term is 80%. It might be 75% or 70%, but there are options out there.
Okay. And we'll move on to the next lending product, which is hard money. What is hard money? When would investors use it?
Sure. So hard money fix and flip loans, bridge loans, renovation capital. Again, it's a means to an end. And right now, there's a lot of bad connotation because the interest rates, the fees, etc. Unless you have your own unlimited capital, you're going to need to borrow it from wherever it comes from. And I can tell you right now, the rates on if you have a HELOC, you're probably paying about 9% on that HELOC money, right? On your primary residence, maybe higher.
Yeah, so, I didn't know that. That's high.
Yeah. Prime rate is, I think, 8.25%, 8.5%, something like that. So typically a HELOC is prime plus something or prime at prime. So they're up there.
Gotcha.
So the hard money, while you might be spending 10, 11, 12%, it's really for the investors. There's not a lot being looked at. If you talk about a low doc loan, this is it, right?
Gotcha.
We're looking at the property, the value of it. You'll always get a portion of the purchase price funded, and then typically 100% of the renovation costs.
I did note that for lending products, it's also a lot about speed, right? For hard money, it is for when you need money fast. And we didn't really discuss this with the FHA and conventional. Those are going to take 30 days. I mean, they're going to take 30 plus days. I mean, maybe you take a little bit less, but you're not going to be able to get an FHA loan in 3 days. I mean, that does not exist. No one can do that. So a lot of these are going to be, for investors, are going to be based upon speed. DSCR you can do much quicker than conventional and FHA. Is that right, or am I off? So DSCR is it still? It's not super quick. It's not tomorrow. You can't get, hey, I call you up and you get funded tomorrow. But hard money is more for investors that need money quick. Can you give us what is like a standard hard money rate that people should expect, that a real estate investor should expect if they're going to use hard money? And let's say they find a deal and it's an amazing deal. I mean, a lot of times we worry so much about what the interest rate is, but if you find an amazing deal and the only way to get that amazing deal and tap into the equity is to have a higher interest rate, then it's worth every second. The speed on money or velocity of money is so worth it. So yeah, what is a hard money interest rate, and why would an investor want to use that product?
Well, one, you're buying houses. When you're using hard money, you're buying homes that are not livable. You're buying homes that you are going in to putting capital expenditure in to renovate it, and then ultimately, whether you're selling it or whether you're refinancing it, increase the value, right? Add value add, and you'll have an end asset. So again, just like your materials, just like your labor, it's a cost. Right now, it could be from 10% to 14% with a few points added on. But you got to remember the rate, whether it's 10%, whether it's 12%, is pretty irrelevant because you're going to have it for what, 4, 5, 6 months.
Hopefully, that's what we're going to recommend for investors. Yeah. I mean, it really only matters if you are not investing correctly, and then it does matter. I mean, if you have a hard money loan for 2 years and it's at 12%, then yeah, you're going to be hurting. And you should be looking to churn and burn properties and get them fixed up and have your team in place.
Most hard money loans you're not going to have for 24 months because they're really at large 12-month loans.
Gotcha.
The file's still underwritten. It's still looked at by an investor. Now, I can tell you I've personally lent my own money, right? When I have capital, I'll lend to investors that I've worked with in the past and, whatever I charge. So, but these are people who are usually turning them around. They're pretty quickly. When you're getting started off, you obviously, besides the lending and finding the property, you need to have, and as you know, David, right, your contractors in place, all these different avenues in place so that you aren't sitting on the loan, because the last thing you want to do is run into month 12. And I've had it before. I've had it in like an area in New York. I have a client right now who she had the loan she's had it for going on 12 months, and permits have held her up. She could barely do anything. She could even barely start on this property for the last year.
Yeah.
So there's so many different factors that come into play. But ultimately, these are short-term loans to be able to get into the property, get it renovated, have your exit plan, exit strategy ready to go so that you are out of it in that kind of time frame.
I'll add to that, lowering red tape with, documentation and stuff. A lot of times if you, and this is with all of real estate in general. Once you've developed that relationship and you show that you can get a property to the finish line, you can renovate it, that you've done this before, you've done it over and over and over again, you've developed that relationship so you can just go to that hard money lender and there's not a lot of, hey, send me your latest W-2, send me this, send me that. It's just, hey, you're betting on almost the jockey and not the horse, if you will.
Getting the first one financed with any lender, whether it's with me, whether it's Joe down the street, it's always going to be a little bit more cumbersome, for lack of a better term, because they don't know you, they don't have your profile. But once you do your first one and we have your experience, your track record, we have your entity approved, right? We have all the, we have your LLC documents, all that's good to go. The next one, boom, pretty much you get an appraisal if needed. You get the title, you get your insurance quote, you get all these different things, these pieces, and it's half the time.
Yeah.
But I mean, the thing about working with someone like myself who is experienced, knows what you need up front, they know how to do everything in a timely fashion. And going kind of back to what I was saying, in the commercial world, when you get into borrowing, there's a lot of brokers out there, and I hear a lot of horror stories. You might not hear from someone for weeks on end.
Yeah.
and they might disappear because there's no licensing, there's no regulation for it. So
Yeah.
really anybody can come in and do it. So do your due diligence. Go like I do anything, right? I want to go eat somewhere. I'm going to go look at reviews. I want to stay at a hotel. I'm going to go read reviews about it. So do your due diligence for your own sake. When you're getting into this, you have a lot on the line. You have not only your money, you have your peace of mind. You might have a family that's, sitting there wondering what is dad doing now,
Yeah.
since you move. And so it's important for yourself to be able to know that you're working with the right people.
Yeah, 100% agreed. The last financing piece, unless I've missed one, is OPM, other people's money. How do investors think about other people's money? How do they utilize it in their lending journey? I don't want to leave that piece out because I think it's important. I think it can play a role. It can definitely play a role down the road, play a role for early investors that maybe they don't have any money to put down and they have to figure out a way. Well, I need that 5%, even if it's 5%, for FHA, I need the 5%. Where can I get it? When would an investor use OPM and what does that look like?
On that, just to comment on what you said, right? FHA, you can't borrow other people's money for buying primaries. You can get gifts if you have family. Gifts are allowed. Can't borrow other people. But when you get to hard money, that's really where you're going to start using other people's money. And you can do it on debt service loans too. The money typically has to be in there for a little bit, or we have to see where it's coming from. But so, like I said, I'll lend my own money every once in a while.
Mm-hmm.
This is going to be to someone who's a little bit more seasoned. When you are newer and starting out, there's obvious inherent risk with that just because you haven't done it. What I've seen a lot of people do over the last few years, let's say you have two investors, okay, they're very good friends and they both want to start out doing this. And this is kind of getting too in depth. And you got to go do your own research on it, but it is a very great tool. So a lot of people have IRAs, right? They might have money sitting there. They can take that money in an IRA and move it into what's called a solo K, which is basically a self-directed retirement account. At that point, let's say you have $100,000 in this self-directed account. Okay, let's say you're tired of the stock market, right? You took all the apple you could possibly take anymore. You're done with it, right? You made some money, fine. Now you can take that money, you put it in this self-directed account, and there's different administrators. I think Wells Fargo maybe has it, but you can Google it and ask around, ask other investors. But you have that $100,000 sitting there. Now, David, let's say you come to me, you have a deal, like you're like, this is a good deal. We've known each other for years. I trust you. I can actually lend you $100,000 from my account, charge you, right? You're new. I'm charging you 13%, let's say, and a couple points.
Sure. Yeah.
Okay. Whatever it is. I can lend you that money from my account. Now, I can't use it myself. To the best of my knowledge, you might be able to use a little bit for your own deal. But that money is held. It's not really technically your money. It's the retirement account's money. So I lend you that money. Let's say you're paying me whatever, $1,500 a month in interest payments.
Mm-hmm.
That money's now going into the retirement account, and you're making 13% on that money, plus the points, whatever you're charging. So now David finishes his loan, pays you back 6 months later, and now that 100,000 is now 115,000, and you do it all over again.
Yep.
That's the way a lot of investors use other people's money.
Awesome. Thank you for sharing that. And yeah, there's a few companies. We'll do a separate video on using a self-directed IRA. I mean, because there's a bunch of nuances, and I am definitely not a specialist. But yeah, that's definitely one way to use.
Another thing to look into for investors, let's say you own a property. Let's say you have a property that, it's worth $300,000 and you have it sitting there and it's, the tenant's in there, whatever, it's cash flowing for you. But you really think, man, if I had $300,000, I could take 100 and turn that into 3 other properties using leverage, right?
Mm-hmm.
You can sell that property and use a 1031 exchange, which is going to defer all that tax dollars and you move it right into other properties. So you're not paying taxes on it. And now you can use that to turn it into more properties, to 3 other properties. That's really your money, not other people's money. But it's also, it's something that a lot of investors use, and it's a really good tool. that I feel like a lot that maybe some don't know about and should look into, right?
Yeah. Yeah. I mean, we'll do a whole video on 1031s because it's also a super in-depth topic and there's different ways you can utilize it and to comprehend how it works. I still am like learning new things about 1031s and how I utilize them. I would like to dive straight into the next section, which is how are the investors that you see that are succeeding, what tools or how are they using lending as a tool? So new investors don't have to recreate the wheel. They can see what it looks like down the road. They can say, hey, this is what the best investors are doing, and this is how they're utilizing lending. Products are they utilizing to grow their portfolios?
I would say burring, what you do, right? With some of the other bigger guys that I work with too, buy, renovate, rent, refinance. You're going to use both avenues. You're going to use hard money in that case. You're going to acquire the property. And typically it's not major projects. You're not, popping the top on a house and doubling the size of it. It's going to be more of a property that you're going to purchase. You can get in, do a pretty quick cosmetic reno, whatever the case may be. Obviously, you want to do your analysis up front on the rents, what the rents are going to look like, make sure it's going to cash flow at the end of the day. Place your tenant, refinance it, secure that long-term debt service or conventional financing.
So investor has 25, 50 properties. Say it has 50 units. What you're saying is normally it looks like when they go to purchase the property, they purchase with hard money. Is that right?
Correct.
They do the renovation. So it's usually a value add. So they'll renovate the property. And is that still with hard money on like renovation draws?
Correct.
And then once they have it all finished and it's looking good and it's rentable, that's when they refinance it, or do they place a tenant and then they refinance it under a DSCR loan?
Typically, once I engage most of my investors, once you're about 2 weeks away from being done.
Okay.
Most of the time you're going to need a tenant in there. But if it's something where for whatever reason you're like, hey, I mean, I'm waiting on a Section 8 tenant, it's going to be another 2 months. There are options to do it vacant, but you're typically you're gonna want to start it once you're starting paint, or something like that.
Gotcha. And then after they have that DSCR loan, then they're taking that money and they're starting the process all over again. Okay. I wanted investors to be able to see what the picture looked like down the road, hard money, renovate, DSCR loan, rinse and repeat. Awesome. We're going to move on. I'm going to ask you some bonus fire round questions if you're ready for them.
Yeah.
All right. The first one that I actually think is super valuable. We talked about credit a little bit. We talked about debt to income. What should investors be focused on to get the best rate possible? I mean, should they focus on income? Should they focus? Is it more asset specific? Does that question make sense to you? What does their profile look like? What should they be focused? What should their credit score be at or above? What should they really harp on to be valuable clients to a lender? So a lender's like, man, I really want to lend to this person as much as I can because they're a rock star.
Credit 760 and up. I mean, if you can get 780 and up, that's ultimately the goal. Typically 760 is not going to be a very huge difference, if at all, but credits, I would say, is the number one. Because all the other factors, the amount of reserves you have, typically going to be either a yay or nay type of answer.
When you're talking about reserves right there, you're talking about liquid money they have sitting in a bank account?
Correct. Or, we'll look at, for reserves, we'll look at retirement accounts. We'll use a lot less unless you're of age. Credit score is going to be the biggest factor because the rest of it is really not going to play into. It's either approve or not. It's either or not, but it's not going to really determine whether or not it's going to your rate. We'll price out a scenario after this, and I'll show you what the difference will be with your scores here or there.
Gotcha. Okay. So the main thing you're telling investors, your advice to investors is make sure you try to get that credit score 760 plus.
Yeah, ideally.
Awesome. And it doesn't matter over 780. Like
we'll try it out. With one of my main investors, we'll check it out and see where it lies. I don't think it's much different, if at all.
Okay. national lenders, local lenders, does that even matter? Should investors be focused on one or the other? Or should they, is there a benefit to have a local lender in the market that they're investing in?
I'm going to say no, because I cover nationally. I mean, I have clients in California. Yep. I mean, I just did a loan in rural Washington. I would say the only time that would matter is if they're lending like their own money in a specific area. Mm-hmm. There are lenders out there who have, a couple $1 million in the bank and they're lending money. They might only want to stick to a certain geographic area, but they're few and far between. Most institutional doesn't really matter per se.
So no benefit of having a local lender normally. No huge benefit of having a local lender over a national.
No.
Gotcha. Okay. I'm curious with rate buy down, and we're talking about buying down your interest rate. Is there a hard and fast rules that investors should follow? Is there some sort of like hard and fast, you should buy down the rate when X? That's the question I'm asking, that new investors can go, okay, Jordan says I buy down the rate when this happens, or,
Yeah. Right now in this market, I'm going to say no. I'm going to say buy downs typically are not worth it.
That's because why? Give us a base example.
Trying to go into our next question, but they're historically higher right now. So odds are probably not going to be for a year and a half, 2 years at least. Rates are going to come down.
Give us an example of what a buy down. If you pay 1 point, what does that usually do? That lowers your interest rate by what?
And it could be a 0.5% in rate.
Okay.
It could be a little bit less. It's all going to depend on the investor. But typically, it's depending on the amount, it's all relative. So let's say it is a 2-to-1 buy down, right? Let's say your par rate is at 7.8%.
Gotcha.
If you pay 1 point, you're going to get to 7.3%. That's a 0.5%, right? So it's going to take you at least 2 years of making payments to recoup that, essentially. 0.5%, right? 1 year's worth of payments. Okay. So if you think you're going to have the loan now, in that case, that's a pretty good buy down. I would say probably do it at that point. But most of them are not that much, right? Most of them you might only get 1 point, might get you a quarter. Then you're looking at 4.5 years, etc., to recoup that. These loans right now, like I said, when your rates are in the 7s, that sort of thing, if they fall, unless the loan's a very small loan amount, if they fall down into the 5s, listen, that may never happen. Odds are it'll probably come down though, right? You're going to want to refinance into that lower rate. So it's not worth spending the money now. You're better off spending it if the rates are mid 5s and you can buy down to, 4s. Yeah, it's probably worth it, because chances are you're not, even if they come down, you're not going to really refinance. That's an aggressive rate.
I love that advice. Dude, thank you for sharing that. Yeah, I love that advice. Think about that. You're probably going to refinance in the future.
Most likely, yeah.
Most likely. I mean, yeah, we're speculating. We're speculating here. Rates could just go up forever.
I mean, if I had that crystal ball, I wouldn't be doing this video. No offense.
Yeah. But that's one of the reasons why you might not want to buy down the point, because if the rates go down 2%, then you're going to refinance because you're going to be saving a bunch of money. So yeah, thank you for that advice. That's going to be very helpful for people. Finding a legit lender for a novice real estate investor, is there something they can look up other than reviews? My common advice for everything is go off of like references of A players. Jordan is an A player lender. Maybe I'll ask him, do you know any contractors? A players work with A players, and they're not going to give you somebody that is lazy and sucks or is a scam artist. How does a novice avoid getting like scammed on like a hard money loan?
Referrals and reviews.
Gotcha.
And make sure if you're going strictly off reviews on somebody, actually look at them and make sure they're coming from like people who have multiple reviews, right? Because I've seen different things in my own experience when looking for things on Google, for example, right? There might be 15 reviews, but they might be from like Joe Schmo who only have one review and are only reviewing this company, so you never really know. And, it's just, reviews are one thing. Ultimately, referrals, that's where most of my business comes from.
Yeah.
And I rely on that. So I would say that's probably the biggest thing. Otherwise, it's tough because there's really not much out there. There's no, like I said, there's no regulation for it.
Gotcha. Okay. I mean, yeah, it's a hard question. If we can
Yeah.
save an investor
Yeah,
from getting
sure.
scammed on a hard money loan, I would love it.
And here's the other thing. If it's too good to be true, it probably is, right? The old adage. And
Yep.
I've seen that so many times. I've had investors come to me and they're like, oh, I'm getting it cheaper here. Okay, go ahead. And then, a week later, they're like, they disappeared, or they couldn't do this, or I lost my EMD, whatever the case may be.
Yeah.
So, if someone's promising you the world, just, I'm not saying it's not real, but do your due diligence, whatever that looks like.
At the very least. I mean, call if you have to call for references. I mean, hey, who is the last couple of people you? I mean, and I'll just give you a base case scenario of like a background check. Is, hey, who are the last 3 people? Can you give me 3 people that you've done loans with? And then when you call those people, ask them what addresses did you purchase under, and you can just search up the property tax record. And if those are not the people, or they don't own the LLCs, then we got issues. Like, hey, you're telling me. So, I mean, that's one way you could probably cross check. Luckily, I haven't had to do that because I've been working with the same lenders for a while. So, but just be careful when going to a crazy lender, or they're giving you wire instructions to send to the Philippines bank of Nordic America, and you're like, what is going on here?
Well, never really be. I don't want to say never. That's not true, because some do require upfront, but just be careful. Yes, where when you're getting asked for money, besides appraisals, right? Appraisals, and sometimes there's upfront due diligence fees that do get asked for, because a lot of the times what'll happen from a lender's perspective, right? You will have an investor. Some are more finicky than others, and really, what a good practice is not to do is to go start a loan with 3 different lenders. That is how you can rock the boat and kind of get yourself a bad name out there, right? You don't want to start a loan. If you shop ahead of time, okay, if that's what you want to do, by all means, but don't start a loan with me. Start a loan with Joe down the street, Tina down here, and have it going in 3 places. I've had that happen before, and some of us work with the same investors, and we've had it, and they're like, and they don't like to see that. Underwriters don't like to see that, right? Because you're wasting somebody's time, by doing that, and it can create issues for you. And I've seen it blow up in people's faces by doing that.
Gotcha.
It's not fair to the lenders, and you're not doing yourself any service. Get some quotes ahead of time, by all means. I'm not saying that, but don't submit the same loan to 3 different places.
For prepayment penalties, what should investors be looking out for?
There are very few on hard money loans. There might be like 3 months of interest required, something like that, which is typically not a big deal. Mm-hmm. You're going to run into prepayment penalty loans, which means that you pay off the loan or over 20% of the balance of a loan, typically a debt service loan, in a period of time, in a 12-month period of time. Right now, the average is anywhere from 5-year to a 3-year prepayment penalty, meaning if you pay off the loan in 5 years, year 1 would be the first year you have it. It's typically going to be a 5% penalty. Chances are, you would never do the loan if you're going to sell it anyway, but you're probably not going to refinance it in the next year. Don't see rates coming down. Maybe into year 3, probably not into year 2. So most of my investors are doing a 3-year prepayment penalty. Now, the 5-year prepayment penalty is going to ultimately carry the best rate. You're going to get the better terms with that, right? Instead of 7.8, you might get 7.6. So it's a quarter better. But if you go to refinance in 3 years, year 3, you might owe 3%, or still it might be a harder prepay at 5% it's of the loan amount, the principal balance. 3-year prepay might look like 3% year 1, 2% year 2, 1% the last year. So even if you're into year 3 and you refinance, the penalty might only be 1%. But anything short of that, a 2-year prepayment penalty, your rate goes up exponentially. And the reason for this is that these loans, inherently, the rates are not far off from where conventional loans, like I said, are. But ultimately, they want to make sure that they're doing this loan. And these loans are also, typically getting sold in the secondary market. So there's cost involved with that. They want to make sure that they're not going to lose money on them. It's a way for them to really, okay, we're going to make X amount of money on this loan. They're in it, like anything, it's a loan. They're in it to make money. So, but right now, most of my investors, I recommend 3-year prepayment penalties just because the difference in rate from the 5-year to the 3 years not significant.
Gotcha. Okay.
Now, fast forward, 2 years from now or 2 years previous, when rates were in the 4s or maybe hopefully get down to the 5s, a 5-year prepayment penalty at that time, that's fine. Again, because they're probably not coming down a lot further from that.
When you're financing a property as an investor, what should you plan for closing costs? Is there a certain percentage that you say, hey, when we're closing on a property, you're using it, we'll say normal loan, is there 3%, 4%, 5%? What should investors plan for closing costs when they're running their numbers?
It depends on the state, but on average about 5%, I would say.
Okay.
Because you're going to factor 2 or so points, whether it's origination discount on average per loan, give or take, maybe a little bit more. Then you have title fees, you have taxes are going to be due, whether it's 12 months, whether it's 3 months, plus an escrow account. You're going to have a year's worth of insurance. If you live in a state like Maryland or Virginia, you're going to have transfer tax, Florida. So I would say 5 to 7% even, is a safe number. Gotcha. So if you're looking to buy a property, typically, let's say your credit's good, the numbers look good at 20% down, you have your 20% down payment. If you're buying a straight rental, that's already turnkey, plus the difference, right? So 27%, 25%, somewhere around there.
Gotcha. Okay. Kind of want to start wrapping it up. I would like to have you quote us out on a property that, and I'll just give a baseline. This is a property we purchased, I think, into April, currently close to July 4th, I think it's July 5th. And we purchased it with cash. We fixed it up. This would be a normal thing that I would call Jordan about and say, hey, Jordan, I'd like to know what the rates are so I can kind of see what my final numbers are. What are the rates and what information do you need from me?
Yep. All right. So the first thing, and typically you can always, I have a little quick form. If you ever have a scenario or question, you can email me. My email is simple. It's Jordan, Jordan, at jordanlevmortgage.com.
Yeah.
So David, roughly, right? Let's for this example, what's your credit score?
Credit score is 755, maybe 750, 760.
And what is the address of the property?
1223 East Oliver Street in Baltimore, Maryland, 21202.
What do you think it's worth right now?
Probably right around 200. We had a comp that was an in unit is under contract. I don't know if it's closed yet. It was under contract for 225. I mean, we could say it's worth 210 or 215. I always like to be conservative. It's a good philosophy for investors. Just stay conservative with your numbers. If you think you're going to get so much in rent, it's okay to think you're going to get $100 under. Some people might fault me for that and just say, hey, I mean, that's stupid. You don't actually know what your true numbers are. But I just think it's a good practice. It's lower risk for me. So I'd say, let's say 210.
What are the market rents right now? It is not leased, correct?
It is not leased. We do have a voucher tenant that is submitted a voucher. So we have to go through inspection, and that looks like the leasing agent listed it for $2,195. I was thinking that we were going to get somewhere around $1,800, but I guess that is market rent. We use a third party leasing agent that does our leasing. Let's say $1,895 conservative, but it looks like my leasing agent thinks that they can get $2,195.
What is the insurance? Do you have insurance on the property right now? Long term?
So insurance is usually somewhere around $700.
And then what are the property taxes?
I want to say they're like $1,500. I don't know.
Now you're looking at Zillow, but probably going to be higher.
We'll just go with rough numbers. I actually don't see it listed on Zillow. I think it's somewhere around $1,500 a year in property taxes. And
then no flood insurance or HOA fees, right?
Nope.
And you've owned this property for, it'll be 90 days, right?
Seasoning? Yep. Okay. Yeah, it's actually a little over 90 days.
Okay. So seasoning, what seasoning is, for those that maybe aren't aware, is from the time you purchase the property to the time that you look to close the financing. Most of my investors, some are anywhere from they want to see 6 months before we can use the full appraised value, but some are 3 months. So in this case, I would use, being that it's only 90 days out, Dave turns his properties around quickly. So I would use that, which also happens to be the better rates on the market right now. And here's the thing, right? So you said your score 755. Okay. At 75% financing right now, right, with no buy down, okay, no additional buy down, you're looking at about 7.965%.
Gotcha.
With the principal, interest, tax, insurance payment, PITI, at $1,335 a month. So you're still cash flowing pretty nicely. You're at a 1.42 overall debt service.
Yep.
Okay. Now that's pulling out because you don't owe any debt on the property, right?
Correct. Purchased with cash, did the renovation with cash, and then we renovate. So we skip on hard money and costs.
Now, most probably won't do that. Most people will probably have debt, right? So let's say, for example, okay, that let's say you borrowed $150,000 to do this project in hard money, and you need to just do a regular refinance of it.
That's fine. We can do that. I'd also like to check out, and this is guys, this is normally what an exact phone call sounds like between me and Jordan. So you're kind of getting the experience that we have. So it's almost like you're going through the rep without having to purchase a property and get a refinance. I would normally say, hey, what does 70 LTV look like, Jordan? What does 65 LTV look like? And this is going to let me see the rate, and I'm going to calculate the numbers, and I'm actually writing down what he's saying. And this is the first time that he's quoted it out for me. So I'm getting this information for the first time too. If you want to do with the example of the hard money, or if you want to go and show it at a 70 LTV, which is loan to value, which he explained earlier, and 65 LTV, which basically means we'd refinance, 75% of the ARV, or the total value of the property.
Yeah. So let's say we do the same 75% rate and term. So let's say you had debt, okay, and you're not just getting cash out, that rate would fall to 7.59. Pretty significant difference.
Just because I had debt on the property, and
correct.
And to explain just a little bit in more, it's like, why would I pay less of a rate if I had debt than and it's because the cash out refi is more expensive, because the appetite for lenders, they don't want to pay a bunch of money to you out of pocket, because now I have this money, I run to Vegas and put it all in black or whatever.
Why? But yes, you're doing a cash out as opposed to just a rate and term, meaning you had debt, which shows you can pay that debt, whatever it looked like, and you're just paying it off. You're not actually getting the cash in hand. So I don't know if that's necessarily the concern. Maybe, I don't know.
And it's increasing my debt. I mean, I have a zero payment, and now I'm going to what Jordan quoted on the first one for the 75% LTV, 1,335. Now I have that payment, so now I'm a little bit riskier borrower at this point.
Yeah, right. Going back to your 75%. So 75 is max cash out. Now, when you fall to 70%, your rate drops, kind of where we were in line, right? Pretty significantly, 7.59. So that brings your payment. Now you're getting obviously less money. You're getting 5% less leverage, but your payment goes down to $1,220. Your rate falls, 40 basis points.
And just so you guys know, immediately what I'm doing as the investor, when Jordan's telling me, Jordan is on one side of the desk. He cares about some things. I'm caring about other things. Dave Hathaway, the investor, is caring about cash flow. So that's what I'm calculating out. And on the first example, the 1,335 and our rent at conservative, like I said, Lease Nation thinks you can get 2,100. I think that's a little bit extreme. I think we'll be somewhere around 1,895 once housing comes back with their number. But 560 is the cash flow. So every month we'd be making $560 cash flow. And with this other example, down to the 7.9% at a 70% LTV at $1,220, which would be our monthly mortgage payment, where we are at $675 of cash flow a month, which is great cash flow. We like that. Anything above 500 is, in my books, I'm going, hey, this is a great deal. I do those all day long. I recommend other investors. If you're getting over $500 cash flow, that is your money in the bank. You're very low risk. Washer and dryer goes bad. Stove goes bad. guess what? You don't make any money that month, but you don't lose any money that month. That's where I love it. Like that's what I recommend for anybody that asks me. It's like, hey, what should I buy? And, how much is the cash flow? When they're like, hey, it's $100. Ooh, I mean, I don't know if I'd do $100. I mean, you're risking a lot. Your roof goes bad. That's going a little bit more in depth, and then even if you dropped it down lower, or let's say you move what do you want to do? You want to move my credit score around? You want to see how that changes things?
Let me show you. So a buy down in this situation, a 1 point buy down gets you down from 7.59 to 7.323, which will take you 4.5 years to recoup. It's a long time.
Yeah, it is a long time. So you'd say, hey, Dave, that's not worth it. Dave would say, hey, we're going to do it anyways, even though my specialist is telling me, no, I'm just kidding. I'm usually going to listen to Jordan and say, hey, he knows what he's talking about. 4.5 years is a long time to pay something off. And then you don't have that money because you could put that money into another investment property and have it compounding. But now you have it, you have a lower payment, but you're paying that up front.
So a 760 score doesn't save you much. 0.01, not a big deal. If that. Let's see 780 though.
We're live, folks.
Yeah.
We are live. Jordan is doing this at his desk. No screenshots, no nothing. So
yeah, again, very minimal. So 755 is good. So I corrected.
What was the 780? Was it 0.012?
It was 0.0. Yeah, it went from it was very minimal.
Okay.
Another 0.01. I mean, you wouldn't even notice it.
Which might even be cents, not even dollars on your mortgage payment. Maybe it's $1, maybe not, but that's $1 per month.
You got to understand too, when you're looking at loan amounts on this size in the low 100 range, the payment difference is so small. 2 point buy down saves you $50 a month. You know what I mean? Which, to spend, you could spend $3,000 to save $50. You know what I mean? It's just not. Now, when you're getting up into the higher, if you have loan amounts in the $300,000, $400,000, $500,000 range, that's when maybe you'll look at it a little bit more.
Mm-hmm.
It's all relative though, the percentage to the actual recoup period, but the payment difference, right? When you're looking at it, might make more of a difference. It'll be more substantial. You'll see it more tangible.
Thank you for doing that live example.
Yeah.
Putting all my information for one of my most recent properties out there for everybody to see. But you can see the cash flow, we look for. I want to really thank you for your time. Jordan is an A-player lender. If you're looking to purchase your first property, I definitely encourage you to reach out to Jordan. We will put his contact information in the description. The best place for people to reach out to you, Jordan, is
my cell phone. Email, text, you need a quick response. I mean, obviously we're going to have to jump on a call if it's the first time I've talked to you.
Yep.
But, David and I, most of our communication is text or email, which is fine. We know each other, but it's the first time I need to learn a little bit about you, what your goals are, where you're at with your investing game, how far along you are, how new you are. That's ultimately the best way. It's hard to, when we don't know each other, communicate via text. Of course, you have a quick question by all means, but I always like to speak to somebody for the first time. But yeah, again, check out my website, check out the reviews. Obviously, hearing from David, and there's a different investor boards, which I've worked with a lot of other investors. So, and I'm always around too. I mean, even if it's a question, feel free to email me anytime. I'm often answering emails super late in the evening and whatever the case might be.
And this is why I want to thank you so much for taking, we're way past an hour. So this is what I appreciate you coming on, sharing your wisdom, sharing as a lending specialist, because I'm sure a lot of those notifications were investors reaching out to Jordan. I'm sure he's going to have to respond to a bunch of messages and text messages. I just put my phone on do not disturb. But I really appreciate you. We'll put all the contact stuff. If you want to reach out to Jordan or reach out to myself or my team, feel free to do that. If you guys haven't already done so, I'd love it if you'd like and subscribe to the channel. We put these education stuff out for free to help investors shorten the learning curve, kind of gain an edge in real estate investing so they don't have to go through the stresses, the pulling out the hair that we already went through. You don't need to recreate the wheel. Investing is relatively simplistic. Buy good assets that cash flow, rinse and repeat, and just keep doing the same thing. Work with great relationships like Jordan. But thank you guys, and we'll see you on another educational episode.